Today I'm going to cover interest rates and bonds. I'm going to show you interviews with three different people, different perspectives on interest rates and bond prices. Joe Kernan is interviewing Bob Michael from JP Morgan. He's the Chief Investment Officer of JP Morgan Wealth Management. And he will give his perspective. And he basically is saying, as long as the Fed raises rates, or there is a perception that they're going to raise rates, or in anticipation of them raising rates, bond prices will continue to come down. This has been devastating for traditional 60-40 buy and hold portfolios because they have, for 40 years, since the early 80s, they have been relying on bonds as an antidote to stock risk. And so they do soften the rate of return of equities, but they have also softened the downside risk. It's generally been seen as a good risk mitigation tool for portfolios. However, when interest rates hit zero and bond yields came down to 2% or so, there really was nowhere to go except up. And you could tell it that they came down for 40 years. At some point, they're going to head up. Now, they did stay down for quite a while, but when they started up, that was when the anticipation of them going up, that was when bond prices began to come down. So if you look at the long-term government bond, the ETF, TLT, back to the summer of 2020 to today, that's about 3 years and 3 months. In that period of time, the long-term government bond ETF is down 50%. Now think of that, and by the way, the intermediate term bond ETF, IEF, is down 27%. So think of that as being part of portfolios, and they are in that portfolio to provide risk mitigation, minimizing downside risk. In many cases, the bonds are down more than the equities are. They have not been a good tool. They've been a horrible tool. But yet traditional financial advisors hang on to them because that's what they're taught to do, is you put stocks and bonds together. It's just not a good combination for growth and risk mitigation together. At least now it's not. Of course, they're talking about that, oh yeah, well, now's a buying opportunity. They have to go up from here. They can't go down much further. That may be true. Bonds may go up, and they may go up. I don't think they're going to go up long term, but they may have a short-term rally too, because they are down a lot. They are oversold. So a lot of times, to let off some steam, they will go back up for a while. But as long as interest rates are going up or perceived to go up, bond prices will come down. Anyway, Bob Michael makes a point of that. Take a listen to this.
Joining us now with more is Bob Michael, JP Morgan Asset or Management Chief Investment Officer and Head of Global Fixed Income. For a long time, Bob, welcome. It's good to see you on set here. For a long time, there was a disconnect between the Fed and where long rates were. We were saying, why is this? And people said, well, treasuries are still popular around the world, and we still have a good risk-adjusted yields here. So they explain the inverted yield curve. Suddenly it moves. The Fed only goes up a quarter of a point, and the 10-year moves 1.5 points. What happened? What psychologically happened? What changed? Supply?
Well, I think for a long time, the market thought the Fed was raising rates at a pace that something would break, and it did, the regional banking system. And the feeling was at some point the Fed would have to pause, otherwise they'd run us right into recession. So you wanted to buy every backup in yields. Coming out of the last FOMC meeting 2 weeks ago, I think that's really when the bond market broke down, because everyone looked at the dots and saw that they took 2 cuts out next year. And the rhetoric coming out of the Fed the last 2 weeks has been uniform. It's not only higher for longer, it sounds like higher forever. And it sounds like, when you listen to Susan Collins, a rate cut isn't even on the table. If they do anything, it will be another rate hike. And I think the holders of the long end of the market are saying, why do I want to give yield and carry to hold the long end if they're not going to cut rates anytime soon? I'm out of there. I'm going into the front end. I think the Fed's getting what it wants. It's getting the long end to rise.
Right, without doing anything. And longer duration holders are asking for more. You got to pay me if I'm gonna take that chance.
Yeah, absolutely. You only go on the long end if you think the Fed's about to cut rates over the next couple quarters.
Doesn't it make it more likely now that the Fed will cut, so they remove it from the dot plots? That causes people to not buy the longer duration. Yields go up, and now they're going to need to cut because the economy is going to be slower.
We're doing their dirty work. And if the go back to 2005...
We're a fool to do their dirty work.
Well, you go back to the Greenspan conundrum, which is raising rates and the long end is anchored. What's going on? So what he did is he raised rates a lot higher. This Fed doesn't want to do that. They want the long end to go up, and they're using their words to get it up, and they're getting it. They're tightening financial conditions.
Next, Andrew Brenner talks about the same thing from a different perspective. He brings in Japan. Japan selling U.S. bonds, having sold about $900 billion worth of U.S. bonds in order to prop up the yen. And I'm going to go into that a little more in the next video, but he also alludes to the fact that there is no fiscal discipline in Washington, and there's plenty of blame to go around. So you've got both sides of the aisle. Believe me, both sides are big spenders. There may be a few people, just a few people, who apply any discipline at all. Most of them, they are more than willing to spend money on this and that. And some of it, in my opinion, is probably needs to be spent. A whole lot of it, they could go without spending, or they could spend it more wisely, or look for waste and things like that. The money just sloshes around in Washington, D.C. And as a result, I think because the U.S. is not perceived as having any fiscal discipline, that adds fuel to the fire for Japan and others to either sell bonds or not buy them. So take a listen to Andrew Brenner.
Well, today we are seeing a sell-off in the bond market, and of course that has been exacerbating declines that we saw south of the border and on the TSX when it comes to equities. The catalyst today seems to be job opening numbers that showed job openings increasing from the previous pace, the first increase that we've seen in about 4 months. For some perspective on where the selling pressure in the bond market might end, let's bring in Andrew Brenner. He's the head of international fixed income at National Alliance Securities. Andy, always great to speak with you. What do you make of what's going on? Does it make sense as every single Fed member comes out and really beats us over the head with this higher for longer mantra?
Well, the higher for longer is certainly the mantra that has got the market's attention. As far as the JOLTS number that you referred to, I don't really think that's the catalyst today. The market was already on its way down at around 6:30 this morning. It had a relief reverse. And then I think the big catalyst is when the Bank of Japan had to come in and stabilize their currency as it got above 150 versus the yen. And that just sent the long end of the Treasury market into free fall. Last I looked, the long bond was up in yield 11 basis points. And as we said in our morning commentary, once it breaks this 485 level, we're looking at a 5% type handle. And we're not very far away. Basically, the bond vigilantes have the Treasury market where they want it. There's no fiscal discipline in Washington, and they're just going to continue to pound on the market until something breaks. As I look from 3 years out to 30 years, they're all at roughly 2006 to 2008 high yields, even the long bond, not so much the 2-year. Which is why we've been liking the steepening trade, and that's been very successful for us. We're now stepping away from that because we reached our objective. But as far as today goes, The government deficits are out of control. The bond vigilantes, which is a term that Ed Yardeni coined back in the Clinton years, they're back, and the Fed is not there to support it, and other central banks are not there, and real money's stepping away. Even today, we saw 5 new deals get canceled because the bond market is just too volatile.
I'm going to play this is a blog. It's called Asian Quick Take. And I like it. It's well done. A lot of blogs are not. They don't appeal to me. But this one I thought was well done, had a lot of factual information. In this one, it goes into more detail on Japan selling the U.S. bonds. And the U.S. is not seen as credible. It used to be that the U.S. had the bonds were the safest investment in the world, looked at as very credible. The problem is that the debt in the U.S. is 33 trillion. You probably know that. Well, it just seemed like yesterday. It just wasn't long ago at all when it hit 33 trillion, a few months ago. And now it's 33.5 trillion. 500 billion. Where did that come from? And in that short a period of time, we have no plan. Congress has no plan to pay back $1. The Treasury Department has no plan to pay back $1. They have no plan to pay back $1 of interest. Nowhere in sight. Nobody even talks about it because they know they can't. We're running an annual deficit right now of about 1.7 trillion. The interest on the debt, he alludes to it, is 35% of our annual revenue. The annual revenue right now is about 4.5 trillion. If 35% of the revenue that he refers to is going toward interest payments, I assume that's correct, that's $1.5 trillion going to interest. Almost as much as our 1.7 trillion in deficit. And at some point, because of just the compounding, the interest is going to be higher than the deficit. Just exacerbating the deficit more and more. So again, bonds are in free fall. Japan selling them when they're a big buyer, have been a big buyer. China used to be a big buyer. They started selling theirs some time ago, and now Japan is following. So the biggest holder of U.S. bonds is the public, the individuals in the U.S. And that's done a lot to prop up portfolios. That, as I said, that's not working anymore. When will the public take the position of China and Japan and go, this is a bad investment? So when selling overtakes buying, bond prices fall. So take a listen to this piece from Asian Quick Take.
Welcome to Asian Quick Take. I'm Jacob. In recent days, global financial markets have been rocked by a seismic event. Japan, one of the largest purchasers of U.S. bonds, has undertaken a massive sell-off of its holdings, amounting to approximately $900 billion in U.S. treasuries. This striking move has once again raised concerns about the economic prospects of the United States. Many experts now fear that the U.S. is teetering on the precipice of an economic recession and an impending debt crisis. This divestment action has also cast a glaring spotlight on the undeniable issue of U.S. debt, which has reached alarming levels. U.S. debt has surged beyond the staggering sum of $33 trillion, constituting a daunting 124% of the country's GDP. This situation has led to interest payments devouring over 35% of the total tax revenue collected by the U.S., a deeply concerning sign. Even with the U.S. Treasury's strenuous efforts to balance the budget and ensure that income matches expenditure, the annual deficit remains an imposing challenge, standing at a daunting $2 trillion. Let's now take a deeper dive into this issue, delving into its underlying causes and potential consequences. Since October 4th, U.S. Treasury yields have exhibited a relentless upward trajectory, with the 10-year Treasury yield briefly surging to 4.85%, marking a 16-year high. This has triggered widespread panic within the market, resulting in a pronounced wave of selling. This panic has been particularly intensified by the surge in trading volumes for bond futures, and a market that has sunk to new lows, further fueling the torrent of U.S. bond sell-offs. This unsettling phenomenon has unfolded against the backdrop of divergent perspectives within the Federal Reserve, comprising both hawkish and dovish voices, as well as Treasury Secretary Janet Yellen's backing of a sustained period of high interest rates. These factors have added fuel to the market's apprehensions about the Fed's ability to maintain its high interest rate policy. The turmoil in the U.S. bond market has also spilled over into other financial markets, including U.S. stocks, resulting in a market seemingly ensnared in an unyielding selling mode. As it stands, the U.S. bond market is enshrouded in an aura of uncertainty, prompting institutions like the Bank of Japan to reconsider their positions on U.S. bonds and their valuation.
Next, CNBC's Scott Wapner interviews Adam Sebastian from T. Rowe Price, and he said basically he's looking at the equity side and saying that interest rates and high inflation and valuations are all putting a headwind on equities. So I'm switching over from bonds over to equities now. So, and then if you add to it the potential war in the Middle East, that's not good. And, that's got all kind of human implications, and I don't want to minimize that and get over into the money side of it, but it does put the perception of what that could be, what is and could be, is definitely going to put an additional headwind on equities. This is not a growth economy. This is not a growth environment. There may be short periods of time where equities will go up. I expect that because equities never go straight down, just like bonds don't go straight down. But I don't see that we're entering a new phase of equity growth. But anyway, it's a nice piece from Scott Wapner and Sebastian Page. Take a listen.
Hot jobs report here to discuss. T. Rowe Price's Sebastian Page. He's been a long-time reluctant bear, self-described, I might add. He might be getting closer to neutral, however. Welcome back. It's good to see you. One of these times, I know you're just going to show up and say, you know what, Scott, I'm a reluctant bull now. And why are we at that moment yet?
Scott, I think we're getting closer. We would probably consider closing our underweight, which is about 1% now, so close to neutral, around 4,100 with a higher VIX and negative sentiment. That might be enough to get us back in. I'm still worried about three big macro risks. Rising rates, obviously. Inflation, I think, has risk to the upside. And valuations, just a compressed equity premium. But no, Scott, we're not panicking, but these are serious macro risks to worry about.
And finally, I want to play a brief piece from Mohamed El-Erian. Always has great insights. And he says, basically, the Fed is behind the eight ball, boxed in a corner, phrases, but it's correct. And they got started late. I think I could see that. I think a lot of people could see that inflation was going up and they were saying it's transitory, and it just didn't look like that to me. So I don't know what they really thought, but they got a late start, and Mohamed El-Erian has been very vocal in saying they did too little too late, and now they're behind the eight ball. So it looks like they're going to have to crash the economy in order to get, hard landing, they call it, in order to get inflation down to 2%, which is their stated target. And he says, we may end, in so many words, he says, we may end up in a higher interest rate and a higher inflation world. In other words, it may not just go up and then come back down. The price that we would have to pay and the Fed would have to pay in order to achieve that may be too high. So interesting perspective. So take a listen to Dr. El-Erian.
Your thoughts on that one from 31 minutes ago?
I had three reactions, John, two of which you covered in your introduction. One, this is good news for the economy right now. The fact that we can deliver over 400,000 jobs, if you include revisions, without earnings pressure is good news. It is, secondly, bad news for markets and for the Fed. The Fed is not going to welcome this report, which leads to my third issue, which is over the long term, this may end up being bad news for the economy as well.
Well, let's break that down piece by piece and jump to the Fed piece of it. From your perspective, Mohammed, as you look at the move in treasuries this morning, and let's break it down together, 2-year yield higher by more than 10 basis points, 10-year up another 15 basis points, and briefly at cycle highs, fresh cycle highs just moments ago. Is that the market doing the Fed's work for it, or are you expecting more from the Fed because of these numbers?
So if this were not a data-dependent Fed, and how often have we heard this, we are data-dependent, which is always strange to me, because you are acting with tools that have an impact with a lag. But given how often they've said this is a data-dependent Fed, yes, it puts back on the table a hike for the 1st of November, which means that market now are not just having to internalize high for long, but higher for longer. And that is the problem. When you fall behind right at the beginning of an inflation cycle, you pay the price when you get to the last mile. And that's what we're doing right now.
And finally, I want to say this. You probably watch TV and are very aware of the war that's going on, rockets launched, and Israel's response, people dying, many hundreds of people dying as a result of what's going on in Israel. And so if you are a praying person, you probably have Israel and the people of Israel on your prayer list. If you don't, may I suggest that you do that we all do that, to pray for the nation of Israel and pray for the people of Israel during this very difficult time. Thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.